Tariffs are going to be hitting the auto industry in a couple of days, 25% import tariffs, particularly on products that are coming from Canada and Mexico into the US. The estimates are kind of all over the place. I've seen estimates that prices are going to increase by $2,500 per vehicle on average. I've seen over $10,000 for certain vehicles. I think there's a lot of things that are yet to be known. Companies can change their supply chains. They do have agency in this, so they can move production from Mexico to, let's say, a US plant. If you're General Motors or Ford and you're importing something like an engine, you probably have other options. But this is going to impact the industry. And so I think it's worth looking at the reaction, the market's reaction, and whether that's appropriate for what the future probably looks like in the auto industry. I think one of the things that's really interesting over the past few years is we've really proven that supply and demand is the thing that matters absolutely the most. Tesla has been reducing their prices over the past few years, and yet their deliveries have fallen in the US. GM and Ford, on the other hand, kept their prices relatively consistent, and their deliveries were increasing because they were supply constrained during the pandemic. So which companies are going to come out best? Right now, the market thinks that Tesla is going to be the winner. That was the stock that jumped after the tariffs were announced. That has kind of faded a little bit, but are GM and Ford and Stellantis, are they going to be in real trouble? Or is there a bigger picture to this? That's what I want to dig into. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with one piece that I think is really important, and that's some context into what happened the last time there was a big dislocation in the auto industry. Obviously, there was the pandemic. That was supply disruptions. So that was really important. But that was sort of a one-time event and not something that we can really replicate. I don't know that we learned a lot about. What we potentially learned a lot about was what happened when interest rates rose. So you can see this is from Statista, and interest rates in 2022, kind of beginning of the year this began, they rose from less than 4% for the average new car loan to almost 8% by March of 2024. So over the course of a little over 2 years, you had a doubling of the interest rate that people were paying on their car loans. Now, this is important for a few reasons. One, most people take out a loan when they get a new vehicle. So sometimes you're going to get that from the dealership, which is typically going to get their loans from either a bank like Ally Financial or through the actual institution that is affiliated or tied to the automaker. So GM has its own financial arm, for example. But you don't typically walk into a dealership with $60,000 in cash or even a $60,000 check and walk out with a vehicle. Typically, people are going to take on some sort of a loan. So when prices increase like that, the price of the vehicle increases pretty significantly. I'll just do some quick calculations here. A 5-year loan at a 4% interest rate for a $50,000 vehicle, about $921. The same terms, but just a higher interest rate of 8%, you're looking at $1,014. So right around a 10% increase in the price of the vehicle on a per month basis. So the question there is, what happened to the auto industry when those prices increased? Because that's a real price increase. And what you would think is that companies would have to respond. They're going to have to either reduce their prices so that they're a little bit more competitive on a monthly payment standpoint from before interest rates went up to after the interest rates went up, or give incentives like offering 0% financing, where they're going to have to actually pay the bank, whoever their banking partner is, to reduce that interest rate. So that's going to reduce their margins. So what actually happened? Let's look at a couple of examples here. This is General Motors. You can see that General Motors in 2021 had a 14.2% gross margin. That went down a little bit to 13.5% and then 11.2%. So there maybe was a little bit of an impact from the rise in interest rates. I will say the other big thing that happened, especially in 2023, is that you had a bit of a shutdown because there was a strike by unions. So that happened later in the year, but that was a pretty big impact as well. So you see that by 2024, those gross margins are back up to 12.3%. Historically, this is about where you would expect to see things. But if you go back to this chart from Statista, this goes back to 2014. This was a shocking increase in the interest rate on vehicles from 2022 to 2024. And you can see that over a long period of time, margins didn't go down all that much. Now, this is something that impacted all automakers. This is a look at the same gross margin from Ford. You can see that there is the similar volatility. Those margins go down in 2020, and then go up in 2021 when they start increasing prices because supply is constrained during the pandemic, and then things have come back down since then. You have the similar increased costs from both higher interest rates and then also from those new union contracts. But historically, we're not seeing a huge difference in their margins. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Tesla is the other example. And look at what happened to Tesla. Tesla actually was the one company that was able to increase their supply during the pandemic. They were still growing, still producing a lot of vehicles, but because they didn't cancel their chip orders, their margins went up in 2021 and 2022. But then those interest rates increased. They didn't have the same union impact, but margins started to come down. Why did margins come down? Because supply and demand is actually the thing that's the most important for an automaker. So we go into a world where there's more tariffs. Who is going to be impacted? They have those tables that show what percentage of a vehicle is imported from Canada or from Mexico. Those I think are important to look at because the existing infrastructure, that is where there's going to be increased costs. That's where those projections for $2,500 to $10,000 increase in a per vehicle price is going to come from. But like I said, these companies do have agency. They can move around their production. And remember, Trump was elected in November. He's been talking about tariffs since November. So they have been making plans. These tariffs don't go into effect until April. So that's about 6 months worth of time that they've been able to plan what their future production looks like, where the profitability needs to come from. And think about specifically General Motors and Ford, but this holds true for Stellantis as well. The most important vehicles in their lineup are actually big trucks and SUVs. Most of those are going to be made in the US. It doesn't mean that some of them aren't built or assembled in Mexico. Particularly, I think GM has some of their assembly in Mexico. Some of their engine powertrain components actually come from Mexico. So can that be shifted to the US? I think that's probably likely. Is our costs going to go up? Probably, but costs went up between 2022 and 2024 for consumers, and it just sort of worked out in the market. There are areas where these companies can reduce costs. There's areas where they can play little games with financing. With these companies that have dealerships, they can also push off some of that margin on some of the dealerships. So they're going to say, okay, there's an increase in cost of $3,000. Let's say, you know what, we need to increase the price of vehicles by $1,000. Maybe the automaker, the OEM eats $1,000, so you have a little bit lower margin, and the dealership eats $1,000. I'm just throwing out examples here, but there's a good reason and good historical context to think the tariffs are not going to be debilitating for the industry. And auto sales may fall in 2025, but I think that's more indicative of what's happening with demand than what's happening specifically with tariffs. Now, what I am going to be listening to over the next month or so, we're going to have a lot of conference calls and a lot more detail that's going to come out about how these companies are adapting. So the first data points that we're going to get early in April is going to be the delivery data for basically all of these automakers. Even Tesla delivers their numbers for the first quarter. So we'll know how much growth or the lack of growth that they have. So what was that trajectory before tariffs were put in place? The second thing that's going to happen is earnings reports. So that starts kind of end of the month in April, and we're going to hear what margins look like, what operating margins look like. And again, that's going to be pre-tariff. How much did they import stuff that they need for the next couple of months ahead of time? We know that that's been happening across the industry. How are they moving their production around? Are they moving some of their production from Mexico into the US? Are they going to be able to negotiate something where, okay, you know what, we're going to expand this manufacturing plant in this area, but we want some sort of easing of tariffs from this other area until we actually are able to move that production. All these things are going to be kind of a moving target, especially with the Trump administration, which clearly wants to make a deal about a lot of these things. I don't think these tariffs are going to go away. So this is going to be the new normal for the industry. But I think quickly coming to a conclusion that one company is going to be the winner because of tariffs over another company is probably the wrong conclusion to make. Unless you're making a vehicle outside of the US, you're a Ferrari or some of the vehicles that are coming from Japan, from Toyota or Honda. I don't think these are situations where companies aren't going to be able to adapt and change, especially some of these domestic automakers like Ford and General Motors. I think they're going to be fine because they are selling the vehicles that people want to buy, big trucks and big SUVs. That's what's selling right now. That's where the margin is in the auto industry. That's going to be the case for the foreseeable future. Electric vehicles, on the other hand, may be more in question. We saw the tariff announcement is the next shoe to drop. The costs that come from the government. Remember the context on this is they're trying to reduce the deficit. One way to reduce the deficit is to not give a $7,500 tax credit to everybody who buys an electric vehicle. There's a whole bunch of other incentives that go into battery manufacturing and all kinds of other pieces as well. So does that start to fall down? That's what I'm going to be watching over the next few months as well, along with these tariffs. But hopefully that's helpful in putting these into context. Let me know what you think in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.